Hi everyone, and welcome to the Power Investing Weekly Power Sector Review, where we go a level or two down into the markets, find out where the relative strength lies, and see if we can't find some opportunities along the way. So in many previous weeks, we have gone through and we have covered a lot of the strong and the weak sectors, and even many of the popular sectors like consumer discretionary, communication services that we thought might be reversing, and we have seen some improvements in those spaces. But this week we're going to just focus on the leading sectors from energy, materials, financials, and consumer staples. And I think once I get through that, we're going to have gone through most of what we can. But if we start here with our equal weight sector RS rankings, we can see those are the top four sectors right now. Materials making the move up 18 points over the last 5 days, jumping up to a 91. We'll see that's mainly led by the metals, not really the chemical and basic materials. Energy has been strong pretty much across the board, but again, the charts don't look way out of range. And then financials and consumer staples. We talked last week about consumer staples be weakening, but this week they showed some relative strength versus the markets as a whole. Again, back to the defensive nature based on them showing some strength into the week when the markets did not. We'll come back to the equal weight sectors, but let's run through a few of these, starting with energy. Energy is our highest relative strength ranking. It's in an RSI bull range, and it broke out here to end the week. Not much here to not like. It's been across most all of the sectors, but none of them look super extended. The most extended obviously would be oil and gas production. If we look at the breadth chart, we have percent above the moving averages all in the 80s and 90s, and your McClellan summation, while it's been pretty much playing sideways here for a bit, back and forth, looks like it wants to come up and make a cross here if this breakout can hold. If we go down into the relative comparative, it's still very strong and made a spike up. Again, looked like it might be losing some of that strength midweek, but spiking up here at the end of the week with some of the different geopolitical news. This could reverse, but until it does, it's a fresh breakout. And looking at the new highs, percent making new highs on the 10-day, 21-day, and 63-day, they're all strong and continue to show strength as that sector moves higher. From the subsector standpoint, the rankings are oil and gas production. Like I said, that's the only one that really has moved 17% in the last quarter, moved way ahead. Equipment services, we talked about the last few weeks, has been playing some catch up. And now consumable fuels was one of the better ones this week, as well as seeing transportation start to pick up a little bit, but still down here somewhat lagging. Notice oil and gas production performed the least this week, while these others made some moves. From an ETF standpoint, I'm going to let y'all go in here, but OIH was your leader, RYE. So it's a pretty good spread across the board. It's not just the largest players. When we move over to the materials sector, which made the relative strength move this week, we can see it's been kind of bumpy but heading up here. And if you look at it in its range, it's towards the top of its range that it's been in for about a year. Okay, a little bit less. And even during the bumpy ride we've had recently, it's held up pretty well. Most of this, though, as we pull down, you'll see has been based mainly on the metals. But in the breadth scenario, it is outperforming the markets across most of the metrics, and it is turning up on the summation index here, making a cross this week for us. This is good signs from the materials. Precious metals and industrial metals have been really the leaders here, but again, the relative comparative of the whole sector across the markets is starting to perk up as well. When we look at the subsectors here, like I said, industrial metals, precious metals are big leaders this week with an 8% week for precious metals and 6.4% for the equal weight industrial metals. Those are big moves, no matter how you look at it. The chemicals were up a little bit for the week too, and basic materials were down with some of the building and those types of names, even though lumber was still up pretty big. Natural resources are still outperforming big on the ETF space, have COPX on copper and silver here jumping up, seeing some of the precious and the other metal things moving up. MOO is also looking pretty good, as well as wood in this particular area. When we look at the financial sector, it's up here in the rankings, but I'll tell you, it doesn't give me as warm and fuzzy feelings, as it got rejected here under 60 on an equal weight basis. And even though it's in the middle of its range and up here above where it was last year, okay, so we can't have too much dislike for it. But in looking at this, the way it's sitting, the pullback at the end of the week was stronger than some other areas, and with the rejection here, this might be kind of a signal that it's not buying the last inflation setup here, that this is all still going to continue to run fast and hard. It has looked like it wants to calm down here a little bit. We'll see if it loses the MA bands here or if it can hold them. From a breadth standpoint, it's still pretty strong comparing to the markets across most of them, but like here, you'll see the summation crossed early week and almost rolled back over right here at the end of the week as the weakness comes in. If we get a cross back down here, we'll have to see where that rotates to, and it will mean that somewhat of the inflation play might be starting to peak out just in the short term for now. When we look at its relative comparative, it's still decent versus the Qs and the SPY, but it's kind of flattening out versus the whole universe and IWM, which we talked about in the last video about them gaining some participation. Banks are still your leaders, regional banks, thrift, mortgage, and insurance. Insurance was something we looked at as well that looked like it was working okay, and then got hit a little bit harder at the end of the week and ended up with a down week this week after performing the last few. Might just be consolidating, or it might be having more troubles. The next one we want to jump into is consumer staples. Consumer staples is one I talked last week about looking like it was weakening, and this week it looks like the opposite. Again, what seems to be happening is whenever the markets do weaken, this becomes somewhat of a hiding place, which right now we are in a bear trend, so that's maybe a decent place to be as a hiding place. But we were looking at the breadth last week breaking down and looking much weaker. This week it held up at the end of the week when everything else kind of crumbled. So it's something to pay attention to on this 50 area, and it's still in a bear range. But if we can see it move up over the 60, it could start getting back in. I don't know that that'd be a great sign for the markets over as a whole. But it would be something you can watch for this sector in particular, with the summation index trying to turn up, the short-term breadth trying to turn up. Long-term is still below 50, but also trying to turn up and a little better than the markets to some extent there in the mid to long term. Relative comparatives jumped here at the end of the week, which is what kind of made it stand out to me. So we have to see it keep moving here, but it is, again, looking like a little more defensive a play as it should be. Food and staple retailing is the one that we'll look at here in a minute when we get into the subsectors. Now, jumping into the subsectors, those are the main four sectors. We're going to start with precious metals since it was the top performer, and it is still in a pretty wide range. And overall still towards the bottom of a downtrend from last year. It's flattened out a good bit while the markets have weakened, and looks like it may be trying to turn up here. But again, a lot of people have a lot of weight on this, and I'm just not quite so sure yet. I think it could be in a position to where we are just here playing with, let's see if I can get this, coming to test a trend line. Until it gets through that, I'm not sure that I'm that convinced we have a whole lot going on in precious metals, but it was a huge performer this week, and from a short-term basis might still see some continuation. Going down into the breadth, its breadth did jump pretty heavy across all, short-term especially. Long-term or mid-term went up into the 80s, and long-term still at 46 though. So again, we want to see a little more progression here, but we are seeing some change in character here from the precious metals scenario. Relative comparative is really not that impressive, but it is certainly turning up over the last week or two. But again, not really making a head-turning type of a move. Next is food and staples retailing, which is one of the better performers in the subsectors. Those are all on the universe page as well. I was going to go look at that rankings, but I just wanted to kind of jump in here and take a look at where we were seeing some advantages. Food and staple retailing is a subsector that's RS is moving back higher over the last week or so, as well as the price held up very well here at the end of the week weakness. You can see right here as you look at your trend line, it had kind of a failed breakout and then pulled back, but this sideways line here, now that it's back above it, could certainly be breaking out over the majority of the range area. Its failed breakout came back in. Now it's trying it for a second time. Set up a little better now, trying to move into a fresh RSI bull range. Another subsector that has performed pretty well in a tough sector was consumer discretionary, hotel, restaurant, and leisure. Kind of the reopening play continuing to perform. You can see here its relative strength in blue lines. The 3-month has moved all the way up to 88, and it's starting to pull the 6 and 1 year along with it. The price itself did make new lows back at the end of January, but now is starting to move back into its range and has moved above this little downtrend line here. Again, trying to make a RSI range shift into a bull range. Part of what caught our eye, and then you move down here into the breadth, and you can see that the percentage above the 20-day moving average is up to 87, the 50-day 71, and 48 actually peaked over 50 this week before it pulled back a little bit. This is some good performance versus what we're seeing in the rest of the markets. Certainly a place we could look for better opportunities. PEJ is one of the ETFs that kind of covers that area. There are definitely some others in our consumer discretionary ETF space. Away is another one. You can see here the relative comparative is turning up as well after a little bit of sideways. It's been moving up overall since late year last year, but it's now starting to really kind of perk up against everything here as we have some turmoil overall in the markets. It's showing it's standing out. You can come down here in the bottom and you can look for the specific holdings, rank them the way you want to on the tables, and kind of look for the individual holdings. We'll have some of our own ideas later. Leisure goods is another sector that was up here at top, and it's kind of an interesting one because it's been pretty poor with its RS jumping a lot over the last week to 2 weeks on the 3-month basis. Now it's still in a clear downtrend. It's still for now, RSI got rejected at 60. So for some, this might end up actually being a rollover play. But right now, I think that I would be paying attention on kind of both ways, have a look both ways play type of attitude. Because if it can kind of hold this area, which was the previous sell-off, and then we can continue to work higher, I think we'll get a bull range shift here. If we don't, then obviously we'll see a rollover. But it is outperforming in this last little bounce as we've come off the lows, which is always something to note. From a breadth standpoint, it's still at or poor versus the markets. The short-term breadth's okay. The mid-term is okay, but not doing great. The long-term is pretty bad at 16% over the 200-day moving average. So we need to see that improve, but it has already gotten the McClellan summation cross, and it is kind of running on that particular measure. One more, then the oil and gas scenarios, the consumables. I talked about it being an area that was kind of starting to play some catch up after energy services, and it did break out this week from a nice little pattern in an RSI bull range, and is working higher across that. Its breadth is strengthening, but still not at extremes on the high side, and it looks like its relative comparatives are starting to improve, maybe not versus energy as a whole, but versus the rest of the markets as well. So again, if we get in continuation in energy, you can come down here and look and see if there are some that have not ran quite too far. A big mover this week was BTU. Plenty of other names on this particular list. So hope this helps, gives you some ideas to go through. Certainly hit the site power-investing.com to get an idea of some individual holdings, some ETFs, some actionable different ideas that you can click through and look at the trading view charts on. All right, hope this helps, and I hope everybody has a terrific week.